Hey everyone, thanks for joining me today. In today's video, I'm going to be talking about my $292,000 Wealthsimple dividend stock portfolio. We're going to be going through some updates of some changes I've been making in this account, as well as just how this account's been performing before just scrolling through, diving through some of the stocks I own in this account. So if you like this kind of content, be sure to give this video a big thumbs up. It helps a ton with the channel. Okay, so looking at my portfolio here, you can see in the last month, portfolio's up about 0.7% or $2,000. Past 3 months here, up about 0.6%, so pretty flat. Past 6 months, which coincidentally is the same as year to date here in 2024, up about 4.5%. And then in the past year, up about 7.3%. So not too bad, obviously. The green's better than being in the red. But the overall market, especially if we include the US or just look at the S&P 500, is up much more than that. Let's take a look at some other indexes. You see here S&P is up 26% in Canadian denominated currency in the last year. Last 6 months up 18% versus the 4 or 5 I was. Even shorter term, last 1 month, 3.5%. This differs greatly from looking at some of the top 60 Canadian stocks on the TSX. Last month, 1 month, they're actually down. Year to date, up about 0.5%. So versus the Canadian index, I think I'm holding up pretty well, probably beating it. But looking at the US index, it's just crushing me. A big component of that is really technology. Technology stocks have just absolutely roared. You see here the NASDAQ 100's up almost 30% in the last year. Even year to date here, up almost 20%. Just crazy numbers. They have obviously high weightings in stocks like Nvidia, who in the last year is up 200%. And on a weighted basis, that does a huge amount for the index, given that's an extra $1.5 trillion of market cap that has been added just in the last year here. Some other things that are relevant as well, and we'll talk about this when I'm talking about some of the stocks I'm looking at. REITs have been one sector of the economy that's underperformed greatly. I think they rallied a bit at the end of last year with the expectation that tons of interest rate cuts would happen this year, but it just hasn't actualized. So because of that, the REITs, the underlying securities, have been trending down and have had a tough first half to 2024, as we've only really seen marginal cuts. See here on the Canadian XRE, which is a REIT index as well, down even more, closer to 9%. So that's just the overall backdrop of some of the indexes, how my portfolio's been doing on a comparative basis before jumping into some stocks. So we're just going to go in here, pick my non-registered account, which is where I hold all of these stocks. And for those, I get lots of comments. Probably my most common comment is around how this is a non-registered account. Don't worry, I do have my registered accounts maxed out, and it's very fair feedback I've been getting about having a lot of dividend stocks and this not being tax efficient in a taxable account. I've been trying to do more and more optimizations of making sure my higher dividend stocks are actually getting moved primarily into those registered accounts, and other unique situations that I'm dealing with as well to just manage my overall tax situation here. Looking at some of these stocks now that I have that out of the way, I'll start off with talking about a move that I recently made, and it's really in line with the discussion I was just having. I actually sold out of my life covered call ETF completely in my non-registered account. It was a pretty big investment. Looking at this one over the last year, let me even go longer term here. Last 5 years, I've held the stock for a couple years. I believe my cost basis was right around $21. So this one has paid a very juicy monthly dividend yield, currently paying about 9.5 to 10% yield on it. So lots of taxable income being derived from this one. I think I had close to about an $8,000 position in it, so making about $750 a year in dividend income or distribution income. And now that it went over my cost, I decided it would be a good time just to sell out of it, take that 9.5% gain I've been getting on an ongoing basis, and I moved that entire position into my TFSA. And what I did to make room for it in my TFSA was actually sell some Canadian National Railway stock, and I moved that into this account. So you can see here, my position in CN Rail has ballooned. I now have about $24,000 in this account, or 150 shares. It did increase my weighted cost basis, which, depending on how you look at it, could be a good thing since I realized the gains on the lower cost basis in a tax-free account, and now I just lowered my overall tax burden on a per share basis in this account here. CN Rail is probably one of my biggest overall positions here, and it's just dipped recently, but over the long term, it's provided really good total returns between dividends as well as capital appreciation as well. So I was happy to make that move and kind of get the opportunity to make that move in this account here. Okay, going into some of the other moves and stocks that I own that I kind of just wanted to talk a bit more about. We just talked about CN Rail. One that I've been um, recently adding in this account is Canadian Imperial Bank of Commerce, or CIBC. This stock here in the last year has actually performed really well compared to lots of the other banks, up 15%. With that being said, they're still expected to do earnings per share of about $7, give or take, this year. So we're trading under 10 times earnings. The stock has a 5.5% dividend yield. So they give you about half of their total earnings back to the investors through dividends, and they reinvest the other half. They're really focused on growing in the US, their wealth management business. And I also kind of like how simple CIBC is versus some of the other banks. One of the watchouts is they have a huge Canadian mortgage book, but overall, I think that's pretty safe. That is where, if a big recession happens and we kind of see an '08 situation occur again, which impacts the mortgage book in a great way, CIBC will definitely get hit on the chin from that. But I feel like they're in a pretty good spot overall. I don't think the Canadian housing situation is going to crash. We have a lot of demand and not a ton of growing supply as well, especially with inflation and interest rates and stuff like that. It's really tough to build on large scale. So overall, I feel comfortable with this one. It's nice to have one kind of more pure play Canadian bank stock. Don't have to deal with all the regulatory issues with TD in the US, or Bank of Nova Scotia or Scotiabank dealing with all of their issues and provision for losses in their South America division. So this one is just a much simpler play, even though I do own kind of those three names. CIBC is the one I'm trying to add a bit more to here. Pretty new position, as you can see. Continuing to go down here, just trying to pick a couple names to go into. I have some stable names here that I just like for the long term. It's stocks like Coca-Cola here. Let's take a look in the last year. Hasn't performed great, up about 4%, which versus the S&P 500 is way underperforming given all the tech stocks blowing up. But this is just a company that over time I think will perform well. Last 5 years, up about 25%. You also get a nice stable dividend yield of about 3%, and it goes up slightly every year. So I just think they're doing a great job of staying on top of trends and continuing to get their fair share of the global beverage market. Lots of markets they have really strong market positions in, and lots of people are concerned like, hey, what happens if people have less appetite for sodas or sugary drinks? I think Coca-Cola does enough consumer research, has enough money going to R&D and innovation that they will get in front of that, and they'll be the leaders of that move into lower calorie drinks or other beverage options. So I'm not overly worried about that huge transition overall as health becomes maybe more prevalent in more consumers' minds. It is kind of a risk depending on how that plays out, but I overall am not afraid to own the stock because of that. Overall here, my position is 250 shares, so I'm up about 6% overall, but it's really that dividend that I get every quarter. I think I get about 120 US dollars, so about 500 US dollars a year, give or take, if my math's right, from my Coca-Cola position. Right now, I'm not adding more. I'm good at this 250 mark, and I think the value or the market cap of this one's in a fair spot given the amount of earnings that they produce. So it's just a bit of a cash cow for my portfolio. Gives me that $500 in my US account on an annual basis for me to invest in other opportunities that we can touch on a bit at the end of this video in terms of where I'm really looking to allocate those incoming dividend dollars. Couple other sound bites here the stocks I want to look at. Realty Income, I kind of took a look at those REIT ETFs at the beginning. Realty Income is a great example of that. In the last year, down about 13%, but they continue to increase their monthly distributions slightly on a quarterly basis. They have pretty good funds from operations exposure. They've been doing lots of acquisitions. Recently bought a 20% stake in the Bellagio, also Spirit Realty, I believe it was called, which I think downgrades their portfolio a bit in terms of quality, but the spread on interest rates that they got on that one was accretive to their overall business. That helps their funds from operations per share goes up. So I think they're expected to do about $4.20, give or take, of funds from operation. Excuse me. So trading here just under 13 times earnings. So we're dealing with about an 8% total market return if I was to take their funds from operations and divide it by the stock price in terms of what return you're getting. And they've shown the ability over the long term to drive accretive growth on that year in, year out, pay a dividend in the meantime. And I feel like as interest rates kind of start going down, whether it goes from 5% to 3.5%, or if it eventually gets down to what it was, during the onset of 2020, 2021, I just think that's going to free up a ton of savings on interest expense. And it's also going to be less alternatives out there for income for investors. And Realty Income is going to be one of the first places they splash back into. In the meantime, I'm getting paid a 5.8% dividend yield to wait. Overall, my position here has not done well because I was buying in the high 50s, so down about 12%. What I will say is I have been buying this one in my RSP account, which is like a retirement account up here in Canada. So I think I have another 75 shares with a cost basis closer to where the stock is today, $52, give or take. So this is one that I'm looking to, slowly nibble more and more into, like the starting yield of 6%, like the long-term growth prospects. Thinks it's well managed, and think it's trading at a discount on funds from operation to price relative to where it can be, and in my opinion will be when interest rates correct up a bit more. Going down to some other stocks here, we have Restaurant Brands International. I own the Canadian one, but it trades both on the Canadian and the US exchange here. This company owns franchises like Burger King, Popeyes, Tim Hortons are the big three. They also acquired Firehouse Subs, and they really work on taking these trademarks and these businesses, innovating with them, driving profit per franchisee, and then taking the model, expanding it globally, opening new restaurants all over the world. Because each one of those new restaurants, if done sustainably and well, turns into a profit center for the overall corporation. They've done that with, I'd say, pretty decent success. They've had some roadblocks along the way, but overall, I'm pretty bullish on their business. They also trade at a much lower earnings per share or price to earnings ratio multiple than like a McDonald's or some of the other names. I think they're in the high teens, whereas some of these other names that I think they're at the same quality as, like whether it be a Yum Brands or whatnot, trade more in the low 20s. So it's a 10 to 20% discrepancy, even if they just caught up on that. In addition to that, they pay a nice dividend. I actually think this is using US dollars for the dividend, so probably somewhere closer to 4% is the dividend yield, which is a pretty juicy dividend yield. I also like that I get it in Canadian dollars, don't have to pay a withholding tax in this account. So yeah, whenever it's under $100 here, I think it's worth looking into. It's interesting. I think they're going to do about $5 of earnings per share this year. If it gets down to $90 or under $90, that's when I really may have my hand forced of needing to buy a bit more into this one. I did get into this one at a pretty good time. I've been averaging up a bit, but my overall cost basis is still in the low 80s, so not in a bad spot, especially when I account for the dividends I've been getting in this one as well. I'm just going to skip down to some of these other ones here. Another stock here, Visa. Visa is one I've held for a long time in a number of different accounts. It's actually been trending down lately. Last month, down about 4%, all in the last week actually. And I'm not 100% sure why, so that's something I'll look into. You get a tiny dividend, but they primarily return their money to shareholders through share buybacks. This company's bought back tons of shares over the years. I think they have about 2 billion outstanding shares. Currently, if you look at my average price here, I'm about $215 in this account, so up about 22%. And given how much of the capital of the company is spent buying back shares, I actually don't mind when the price goes down in the short term, especially if it's something that I don't think is root cause or fundamental to them executing their strategy over the long term. Just means I'm getting more and more percent of the company without wasting as much of the company's capital, which for the long term can increase the compounding effect of the company. I think Visa is a tremendous business. It's one that, in my opinion, is essentially a toll booth on the global economy. As more and more people tap their cards, and even as inflation goes up, people are still using their cards for those payments, so their fees just are going up and up and up. In addition to that, I think they have a long runway on cash to card conversion, maybe not in the more developed areas of the world, but in lots of other areas of the world, still super cash heavy. And I think just those tailwinds and the growth rate that they'll get from those tailwinds coming to life will have this stock looking undervalued in 5 years, 10 years, when you're getting the opportunity to get it for under $500 billion now, or right around $500 billion at $520 billion market cap. It's not one I've been buying recently, but it's one that as it gets down to 260 and lower, one I really wouldn't mind adding more of at those levels. Last kind of topic I'll discuss before going into some stocks I'm finding interesting is some of these ETFs I bought earlier this year. One of my themes for 2024 is I really wanted to bring broader diversification to my portfolio from a geographical standpoint. I bought Vanguard International FTSE Pacific ETF, holds a ton of Japanese equities, also some Singapore, Australia, whatnot, that region of the world. You can see here in the last year up about 5%. I'm up about 4% in this one. Also get a nice almost 3% dividend yield on it. So this is more just a macro play, making sure I have more boxes covered. And then another one, which is I guess a bit more broad, is an emerging markets ETF here. I think this has a lot of China, Taiwan, as well as India and Brazil would be the main ones. Then it's a couple percent for Dubai and some of these other countries as well with emerging markets. You can see down or up about 7% in the last year on the ETF. I'm up about 7.5 points, and also pays a bit of a healthier dividend at 3.2%. So I'd say overall, these ones have gone decent for me. Obviously, trailing something like the S&P, everything without Nvidia in it is in a high weighting is probably going to have not performed in line with the S&P. But overall, 7%, 5% on the Pacific region one, getting a 3% dividend yield as well. And I didn't necessarily buy these to outperform in a major way. It's more just so I sleep better at night. I don't need to worry about having exposure in the individual securities I own in those parts of the world. So I just wanted to wrap up by talking about a couple stocks that I'm looking to buy more of. And as I get more and more dividends from these cash cows like Coca-Cola, like some of the REITs that we were talking about, Realty Income being one of them that I get a nice check every month. These are the kind of places I'm putting it into. So the first one I just started loading up, or I shouldn't say loading up, nibbling on Vici property shares. I've owned this one a couple times over the last 5 years. Ultimately have sold out between $31, $32 the first couple times I've bought in, and then exited out of this just because I wasn't able to build up a big enough position sub $30. When we got down to this 28 range, looked at their funds from operation about 225, so we're trading at about 12 and a half times funds from operation. This company has gotten a lot more messy over the last year or two. They do some private financing for some of their strategic partners, which is a different layer of risk or a different type of investment model that they're deriving income off of. They also are expanding pretty heavily away from just Las Vegas and casino properties, as they've bought out lots of the leases for companies like Bowleroo and assets like that I'm a bit less excited about. But I still think that they are focused and have a great plan to invest more and more money and get more and more of their rent from Vegas as they continue to have rent escalators organically in those properties. And on a 12.5 multiple on funds from operation, paying almost a 6% dividend out, 5.8%. I just think it's at a good value at these levels, relatively low risk given the long leases that they have with lots of their tenants. They've never really missed a lease payment. They've been very strong at increasing the dividend every year. That's driven a lot of consumer positive consumer sentiment or investor sentiment rather. So I think it's worth the risk reward getting the 6% starting yield, um, counting on them to continue increasing the dividend on an annual basis. Also think same hypothesis as interest rates trend down, stocks like this are just going to go up inherently from that, both from a operational standpoint, cranking out more funds from operation, but just I think the multiples will go up too. So I think it'll be a pretty big surge in these big high quality REITs at that time. I'd love to get the opportunity if the price stays at these levels to put more and more of the capital I'm getting from other stocks from as dividends into this name, build it up into a much bigger position so I can benefit from that hypothesis hopefully playing out. A couple other names I've been buying down here. One is Uber. I actually just bought one share today. I've been in and out of this one a couple times too. And just for those who haven't watched too many of my videos, the in and out thing is really irregular for me. I'd say it only happens when I'm trying to buy a position. I'm already a bit iffy or not in love with the valuation, but I do want to be part of the story. And then before I get to build up what I consider a meaningful position to be, it just goes up 10%, 15%. Then I take my gain, and if I can get a 15% gain in 30 days or 60 days, sure, and I just move on. But with Uber here, I got a slight opportunity on a dip. I was hoping it would continue to dip into the lower into the 60s again. I was getting dollar cost average, or still plan to dollar cost average down if that does happen. But it's one that I think they have a potentially huge growth story in front of them. Obvious risk is more like regulatory based, and they're so large now that it is definitely a macroeconomy exposure to this company as consumers may have less money, or if that story plays out, to spend on a discretionary basis. Less people will Uber, as corporations don't want to expense as much money. They won't offer stipends as much, those kinds of things. But over 5, 10, 20 years, I really do think that Uber will be a materially larger company and business as they are today. They'll find new ways to drive scale and synergize their business. And I do think they're in the best position being able to pair the Eats division and the Rides division together. They have a subscription now, and just lots of really good things that I like that they're doing. So I'd love to kind of have that as a growth stock in my portfolio. Another one here I've been building out is Windom Hotels and Resorts. This one went down 2% today. I have about 40 shares in this one, I believe. So about a 3,000 US dollar position, give or take flat, up 2%. It's a 2% dividend yield. But I really like just the franchising model as a business model overall. We talked about Restaurant Brands International. I also have some food royalty comes as stocks as well. And I just feel like Windom is another one of those tool booth kind of companies like Visa, where they're just getting a couple percent off the top. They're driving a lot of growth in the loyalty program rather, and they're building out their pipeline to have more and more hotels open on more and more banners across the world, which is similar to how I was talking about Restaurant Brands International. If done sustainably, if the unit economics make sense for the franchisee, each of these new locations will be an incremental profit center that's going to come back to the corporation. I also really like how many shares they've been buying back over the last 5 years. They're really asset light and capital light. So since 2018-ish, when they went public, they had about 100 million shares outstanding. Now they have 80 million. So they've bought back 1/5 of the company just in 5 years or so. And that's in a 5-year span that they had the pandemic. They also had extremely high increasing interest rates, which kind of make it tough on their franchises. So they've had to provide some, I'm sure, support in one way or another to make sure that their network's strong and made for the long term. So I think that this company can just accelerate even more if interest rates go down as well. You see that's a common theme on lots of the stocks that I own. But even in the meantime, as the stock's down here around 15, 16 times earnings, whatever it is this day of the week, I really don't mind them allocating all of that free cash flow into buying back the company for me more and more and more as we wait for that rise longer term. One of the watchouts with Windom, as I just look at some longer term charts here, is that they do have a lot of more discount banners they show a chart. I wish I had it up. I've shown it in other videos, just where they have 24, 25 banners. The reality is they're heavily overexposed to kind of the discount economy banners, the Motel 8s and Vermatas and those specifically in the US. So US discount hotel and motel banners is where they have a ton of their income coming from. They've done a great job of diversifying that over the years. They've made a couple pocket acquisitions over the last few years, Vienna House in Europe, some other extended stay brands. They're also creating an extended stay brand as well, which will skew a bit more premium. But they're still on that journey to get to a good spot on average daily rates relative to like a Marriott, a Hilton, a Hyatt. they're far away from that. But I do think long term they're going to get those ADRs up. They're going to mix more up into the premium and whatnot ranges. It's just you need to acknowledge that you are getting a lot of exposure to that sector of the economy and those types of consumers. So you have to be comfortable with that, given all the different hypotheses on what the macro will end up being. So those are some stocks that I'm looking at allocating fresh capital into, as well as some of the stocks that have been underperforming and stocks that I'd like in my portfolio, just as core holdings. We talked about Coca-Cola earlier, as well as CN Rail and whatnot. So would love to hear what you guys think of some of these stocks. Do you own any of these stocks? Do you own any other stocks that you think I should take a look at? Please let me know in the comments. If you made it all the way to the end of the video, I wanted to thank you a ton for watching all the way through. Not many people do, so I truly appreciate it. Let me know in the comments as well if you did. And I'll see you guys in the next video. Thank you.